There's a lot of great news right now for companies that are starting 401k plans in years 2023 and going forward. When the government passed Secure Act 2.0, they added a bunch of tax credits to help companies not just offset the cost of setting up and maintaining the plan, but also now they can use some of these tax credits to offset employer contributions that they're making to the plans on behalf of their employees. So there's three main tax credits we're going to be covering today. It's a startup tax credit, which is to offset the cost of the plan. The employer contribution tax credit, which is used to offset those employer contributions being made. And then a third one is the auto-enrollment tax credit for plans that adopt auto-enrollment as part of their plan. We'll start out by talking about the startup tax credit, which is the credit that's used by companies to offset some of the costs associated with starting up a 401k plan, as well as maintaining that 401k plan for the first 3 years. Now, a startup tax credit did exist prior to Secure Act 2.0, but it wasn't as lucrative. When they passed Secure Act 2.0, they enhanced it, so some companies may be able to offset 100% of their plan fees with these new credits. In order to qualify for these credits, the company must meet the following requirements. Number one, the company may have no more than 100 employees who receive compensation of $5,000 or more in the preceding year. Number two, the company did not offer a retirement plan covering substantially the same employees during the previous 3 years. And number three, the plan covers at least one non-highly compensated employee, also referred to as a non-HCE. So let's time out for a second. What the heck is a non-highly compensated employee? So 401k plans are subject to discrimination testing each year. And what that testing does is it splits the employees into two groups: highly compensated employees and non-highly compensated employees. And who the non-highly comps are is anyone who's under a 5% owner in the company or makes under $135,000 in the preceding year. So for 2023, you're looking back at 2022 comp and saying, who are my employees that made $135,000 or less? Those are my non-highly compensated employees, as long as they didn't own also more than 5% of the company in either 2022 or current year 2023. So when you look at ownership percentage, it's not just last year, it's this year too. Another special note about that criteria is the plan has to cover at least one non-highly compensated employee. So it's not good enough to say, oh, we have one, but they haven't met the eligibility requirements of our plan. Not only do you have to have a non-HCE, but they also have to be eligible to participate in that plan in that year. If you don't have any non-HCEs that are eligible, you're not eligible for the startup tax credit. And the other thing I'll mention is, I mentioned that $135,000 comp threshold. That is really for the 2023, looking back at 2022 comp. The IRS adjusts that comp level each year. So if you're watching this video in 2024 beyond, you have to go back and see what the new comp level is for the previous year look back. I also want to pause here and talk about attribution rules, which is another 401k fund term. But essentially, the IRS is very aware that small business owners can become very creative with who owns the companies, how much comp they themselves are receiving or other highly comps are receiving in the company. So as a way to limit some of these small business owner creativity, they put some of these attribution rules in place. When we talk about attribution rules, what we're talking about is assigning one person's ownership in the company to other relatives that also work for the same company. Because again, the IRS doesn't want people monkeying with ownership interests or compensation to slide family members underneath that highly compensated definition. So one of the most perfect examples we normally see is, let's say you own the company 100% and your spouse also works for the company, doesn't own the company at all, maybe makes $30,000 a year. So on paper, no ownership interest, $30,000 a year. Your spouse looks like a non-highly compensated employee, but what they do is they say there's attribution between spouses, which means because you're 100% owner, your spouse is also treated as 100% owner in the company, highly compensated employee. For entrepreneurs that own multiple businesses, they also have to be very aware of control group rules, the affiliated service group rules associated with these employer-sponsored plans, because even though they might be trying to put a plan in place for the first time for one of their companies, the control group rules might require them to pull in the employees from other companies that they own, which can then make them disqualified for some of these credits we're going to be talking about today. So kind of the base case rule is, before you just blindly put these plans in place for your company, make sure you're speaking with a professional that understands all the nuances of these compliance rules for these employer-sponsored plans. Now that we're finished talking about all those fun 401k rules, let's move on to how much this startup tax credit actually is and how it's calculated. So the way the calculation works is, for companies with 50 or less employees, the credit covers 100% of the company's plan costs up to an annual limit of the greater of $500 or $250 multiplied by the number of plan-eligible, non-highly compensated employees, up to a maximum credit of $5,000 per year. For companies with 51 to 100 employees, the credit covers 50% of the company's plan costs up to an annual limit of the greater of $500 or $250 multiplied by the number of plan-eligible, non-highly compensated employees, up to that same maximum credit of $5,000 per year. As you can see in these calculations, the two main factors that determine how much credit you're eligible for is, one, the number of employees that are employed by the company, but two, how many plan-eligible, non-highly compensated employees you have, which the more you have, the larger the credit's going to be. These startup tax credits are federal tax credits that are available for the first 3 years that the plan is in existence. So if a company has enough employees and enough non-highly compensated employees that are covered by the plan, they could potentially get up to $5,000 a year for the first 3 years to help offset plan costs. While we're talking about costs, let's talk about the plan fees that qualify to be used towards these credits. Now, these have to be fees that are paid directly from the employer to the plan service provider. These fees cannot be paid out of plan assets or the mutual fund expense ratios. These are direct expense to the employer. And some of the common fees that you see paid are the fees to initially set up this 401k plan, the fees to administer the plan, the payments to the TPA, record-keeping fees, investment advisory fees, or employee education fees. This is a big sea change for startup plans because historically, when someone was starting up a 401k plan, it was common that they would be on a platform that had mutual funds that had usually higher expense ratios, because those higher expense ratio funds were used to subsidize some of the costs, maybe pay the advisor on the platform, to pay for the record keeping. But now that there's these new tax credits involved, it may be advantageous for both the employer and the employees to use maybe no-load mutual funds and then pay the investment advisor, the record keeper, the TPA directly from the employer, because now the employer can qualify to get reimbursed from these fees from the IRS via these tax credits. Now let's pull all this stuff together in an example. So let's say a company has 20 employees. Of those 20 employees, 2 of them are highly compensated employees and 18 of them are non-highly compensated employees. All 20 employees are currently eligible to participate in the new 401k plan that the company just started in 2023. During 2023, the company paid $3,000 in total plan fees directly to the TPA firm, the investment advisor, and the record keeper of the plan. Here's how the credit calculation would work. Since there's 18 eligible, non-highly compensated employees, you multiply 18 by $250, and that equals a max credit of $4,500. Now, since the total cost for the plan were $3,000, which is actually less than that credit, the max credit this company can receive for those plan costs is $3,000, but it covers 100% of the plan fees that year. The question came up about carry forward. What if the credit doesn't cover all the plan fees? If there's additional plan fees over and above the credit, can you then carry those additional excess plan fees over to the next year to use it for the credit? The answer to that, unfortunately, is no. There is no carry forward of the excess plan fees to future tax years. Since there are a lot more solo K plans out there now, I also want to address the question, do these solo K plans qualify for these startup plan credits to offset costs? The answer, unfortunately, is no, because the very essence of a solo K plan is it only covers owners. So you're never going to have any non-highly compensated employees that you need to be eligible for this credit, so it never becomes available. Okay, that whole thing was just the startup tax credit all by itself. Now we're going to go ahead and graduate over to the employer contribution tax credit, which is truly awesome. This is the first time ever in 2023 that the IRS has ever made available a tax credit to actually offset employer contributions that are companies that are making to these plans on behalf of their employees. In order for a company to be eligible for this employer contribution tax credit, they have to meet 3 criteria. 2 of them are similar to the startup tax credit, but the third one is different. So here's the criteria. Number 1, the company may have no more than 100 employees who receive compensation of $5,000 or more in the preceding year. Number 2, the company did not offer a retirement plan covering substantially the same employee during the previous 3 years. And number 3, the plan makes an employer contribution for at least one employee whose annual compensation is not above $100,000. This employer contribution credit is only available for employer contributions that were made to employees with $100,000 or less in FICA wages for the year. It's important to understand that there is a cap per employee for these employer contributions that qualify for the credit. You can't give someone a $5,000 contribution for one employee and take a credit for the full $5,000. They actually make you look employee by employee, and the formula is for each employee, it's the lesser of either their actual contribution or $1,000. So if someone gets, let's say, a $3,000 employer contribution, the most you get for that employee for a tax credit is $1,000. If that employee receives $600, then you get $600 for that employee. Now, I wish the calculation was that easy for all companies with under 100 employees, but unfortunately, it's not. And we're going to get to that. But first, let's go through a few more steps before we get to those more complex calculations. Before I get into the more complex stuff, let's look at a basic example of how these employer contribution tax credits work. So let's say we have company RTE that has 2 employees that make under $100,000 per year, and their names are Sue and Rick. So Sue receives an employer contribution of $3,000, and Rick receives an employer contribution of $400. So the max employer contribution tax credit they would receive is $1,400. They get a $400 credit for Rick's employer contribution, and they only get a $1,000 tax credit for Sue's contribution since she's limited by that $1,000 per employee cap. Now, S-Corp owners are going to love this next part. So again, in the definition for this employer contribution tax credit, it doesn't say anything about non-HCE. It just says that the employee's compensation has to be below $100,000 in FICA wages for the year. And as we know with S-Corp owners, they can take W-2 and then receive distributions on top of that. So technically for this type of credit, a owner of an S-Corp could receive $80,000 in W-2 income, take a distribution of $500,000 and a dividend, but they would still qualify right now for this employer contribution tax credit up to that $1,000 cap because they're below that $100,000 wage threshold. Here's where this tax credit starts to get a little tricky. So unlike the startup tax credit for the plan costs, that had the same formula for the first 3 years. Now with this employer contribution tax credit, there's actually a decelerating percentage that you will receive for a reimbursement over now a 5-year period. So startup tax credit for the cost was a 3-year. This is a 5-year, but it's decelerating percentages as you go throughout that 5-year period. Similar to the startup tax credit, they split companies into 2 camps, 50 or fewer employees or 51 to 100 employees. So for the 50 or fewer employees, the way the 5-year decelerating schedule works is for year 1, it's 100%. For year 2, it's also 100%. Year 3 is 75%. Year 4, it drops to 50%. And in year 5, it's 25%. Let me illustrate this in an example. So let's say company XYZ starts a new 401k plan for their employees in 2023, and they offer a safe harbor employer matching contribution. So the company has 20 eligible employees. 18 of the 20 are making less than $100,000 per year in compensation, and all 18 employees contribute to the plan, and each employee is eligible to receive a $1,250 employer matching contribution. Since the tax credit is capped at $1,000 per employee, the credit calculation would be as follows. $1,000 times 18 employees equals $18,000. So the total employer contribution to those 18 employees would actually be $1,250 times 18. So that's $22,250. But the company would be eligible to receive a tax credit for year one for $18,000, which makes up a good portion of that total contribution. Now, no, that was an easy example with all the eligible employees receiving over $1,000 contributions. You just easily apply that $1,000 cap. If any of those employees receive less than $1,000, then they would have been capped by that lower amount for that particular employee. Okay, so now we're moving on. We just talked about 50 and under. Now we're going to talk about 51 to 100 employees for this employer contribution tax credit, which it gets even a little bit stickier. Now, the way this works is very similar to the 0 to 50, but with the 51 to 100, they have that same schedule where it goes 100, 100, 75, 50, 25 over the 5-year period. But now, for every employee over 50 that you have, that amount decreases by 2% for every single employee over 50. Wait, what? That is my exact reaction when I read it as well. So it's better to show this an example how that 2% reduction works against the credit. So let's say we've got a new startup 401k plan that has 80 employees. So they're in year one of this 5-year discount schedule. So the calculation would be as follows. You take 100%, because that's the year one percentage, and you subtract, in parentheses, 2% times the 30 employees they are over that 50 limit. So if you do 2% times 30, that gets you 60%, right? So 100% minus 60%, they are eligible for a 40% credit for those employer contributions. To phrase that another way, instead of the employer getting the full 100% tax credit for those employer contributions for that year one, now they're only getting a 40% tax credit. But again, there's a second piece of this calculation that we have yet to go through. And unfortunately, in this second step, this is where the industry kind of hits a crossroads. I've seen some very reputable TPA firms calculate it one way, and I've seen another group of reputable TPA firms calculated another way. And where this crossroad is happening is, at what point in the calculation do you apply this $1,000 per employee cap? Now I'm going to explain this. So calculation one are the group of TPA firms that are applying that $1,000 cap before they apply the discounted tax credit amount. So what that means is they line up everyone's employer contribution they receive for all the employees making $100,000 in comp. They go through and limit all the employees to $1,000, and then they just apply that, let's say, that blanket 40% tax credit we came up in the previous example. The other group of TPAs, which I'll call calculation 2, do not apply that $1,000 per employee cap until after they have assessed that discounted tax credit against that employee's full employer contribution. I'm going to show you in a super simple example why this alters the amount of the tax credit in the calculation. So let's say we've got Sue and Peter, who both make under $100,000 in compensation and work for company ABC, which employs 80 employees. Company ABC just implemented a 401k plan this year with an employer contribution. Both Sue and Peter contribute to the plan. Sue is entitled to receive a $1,300 matching contribution, and Peter is entitled to receive a $900 matching contribution. As we discussed before, since the company has over 50 employees, we have to apply that 2% per employee discount on the total credit amount. So we're going to say 100% minus 2% times 30 employees over the 50. So that results in a 40% tax credit. Now let's proceed using calculation 1, which is applying the $1,000 cap before we get to applying the actual credit that's available. So if company ABC applies a $1,000 per employee cap before applying the 40% credit, Sue's contribution would be capped at $1,000, and Peter's contribution would be $900 because he's under the $1,000, resulting in a total employer contribution of $1,900. And determine the credit amount, we would take that $1,900 and times it by that 40% credit, which would equal $760. Let's shift gears over to calculation 2, and this is applying the $1,000 per employee cap after the 40% credit has already been applied. So Sue received an employer contribution of $1,300 times 40%, which would equal $520 below the $1,000 cap. Peter received a $900 contribution times 40%, which would equal $360, also below the cap. So when you total those two up, $520 plus $360, it equals $880 total credit, versus when we did calculation 1, that credit only equaled $760. Now that was just 2 employees. Imagine multiplying this across 80 employees, and it can create a big dollar difference. Which calculation is right? I'm not entirely sure at this point, which is why we may need some additional guidance from the IRS. Companies are allowed to capture both the startup credit and this employer tax credit in the same tax year. So that's phenomenal news, because you could have a company that qualifies for, let's say, $4,000 worth of plan costs, and they could also qualify for maybe $40,000 worth of employer contribution tax credits, and they get a $44,000 tax credit in a single year. The final credit we're going to talk about is the automatic enrollment tax credit. So auto-enrollment is something with 401ks. When you have a new employee come in and they become eligible, they are automatically enrolled in deferrals unless they decide to opt out. So that's the opposite of old school 401k, which you have to opt into these plans. So the IRS has tried to incentivize plans to adopt these auto-enrollments because it shows usually higher participation in plans because employees just kind of go with the inertia. This tax credit is slightly different than the other two we talked about, because the first two, the startup and the employer contribution tax credit, is available just to essentially startup plans, where this auto-enrollment tax credit is available to both startup and existing plans that want to add this feature. And the way it works is it's a $500 credit that's available for the first 3 years that auto-enrollment is put into place. The 2 criteria to become eligible for this credit is the employer can have no more than 100 employees with at least $5,000 in compensation the preceding year, and the automatic enrollment feature that's adopted, the structure must meet the eligible automatic contribution arrangement, also called EACA, requirements to qualify. Secure Act 2.0 did change something significant for startup plans with regard to auto-enrollment. So any plan that is adopted essentially after December 29, 2022, by 2025, those plans are going to be required to have auto-enrollment as part of their plan. Now, if you adopt a plan in 2023, you can opt out of auto-enrollment for 23 and 24, but as soon as 2025 rolls around, you are going to be forced to have auto-enrollment as part of your plan. So it's one of those, if the credits are available and you can qualify their credits by adopting auto-enrollment now, knowing it's going to be mandatory anyways by 2025, why wouldn't you do that? Now, for plans that were adopted before December 30th, 2022, they are not required to have auto-enrollment in 2025. They can continue to make it an optional provision. A final note for my Simple IRA and SEP IRA plans, those employer-sponsored plans also qualify for both the startup credit and the employer contribution credit alongside 401k plans. So defined contributions qualify, defined benefit plans do not. I hope this information was helpful. If you have any questions, please feel free to reach out to me at moneysmartboard.com. Thank you.